Hello, everyone. Welcome to this webinar on small business tax liability reduction strategies. I am your moderator, Jenny Alton from the New York Small Business Development Center Central Office. This webinar is brought to you by the PACE Manhattan SBDC, a regional center of the NYSBDC. The NYSBDC is a U.S. Small Business Administration resource partner with regional centers at higher education institutions and outreach offices at other locations across New York State. Our free advising, education, research, and advocacy services are made possible by funding from the SBA, New York State, and our host campuses. We are so pleased to welcome Orumé Hayes, founder and CEO of Hayes CPA LLC, as your presenter today. You'll also be hearing from Greg Callender, Advanced Certified Business Advisor with the PACE SBDC. Now just a few housekeeping items. So you know, we are recording today. We plan to share a link to the recording and slides in a follow-up email. Attendees are muted and will not be on camera. Your chats will be visible to me and our presenter, as well as Greg. If you have any questions during the presentation, please don't hesitate to type them in the Q&A box as they come up. You can open Zoom's Q&A box from the Q&A button at the bottom of your Zoom window, and we will try to address questions throughout the presentation, time permitting, and then try to catch any others at the end, again, time permitting. We'll answer as many questions as we can, in other words. So with that, I will turn the time over to Greg.
Thanks, Jenny, and good afternoon, everybody. I'm Greg Callender, an Advanced Certified Business Advisor with the Pace University Small Business Development Center. At the Pace SBDC, the focus of the services we provide, all totally free of charge, are aimed at helping both existing New York small businesses as well as aspiring entrepreneurs who are looking to launch a venture. Some of the services we provide include helping entrepreneurs to obtain financing, assisting with comprehensive business plans and financial projections, developing social media and marketing strategies, applying for various government certification programs, and gathering market research. PACE SBDC's one-on-one services are offered both in person and via Zoom, and both in English and in Spanish. In a few moments, I'm going to place into the chat two links. One is to the main PACE SBDC website, and the second link is one that will allow you to register in order to receive free PACE SBDC business assistance. In addition to the free one-on-one business advisory services we also offer a variety of training and educational programming, such as today's presentation. We've been fortunate to have members of the New York State Society of CPAs volunteer to share their expertise with business owners such as yourselves on a variety of small business accounting and tax matters. Reducing tax bills is always an issue of great interest to small business owners, and thankfully we have Ms. Hayes here today to provide us with insights on this very important subject. So with that, I'll turn it over with our thanks to Ms. Orumé Hayes.
Thank you very much, Craig. I appreciate it. And also thank you to you, Jenny, and to NYSBDC for putting together this, I think, timely and valuable presentation that I'm going to be sharing with you guys today, tax strategies to boost your bottom line, and also to the New York State Society of CPAs. So a little bit about me, founder and CEO of Hayes CPA LLC. I'm a director at large with the State Society, New York State Society. I'm immediate past chair with the AICPA. I also, I am an adjunct lecturer. I teach accounting at the College of Staten Island, and I provide graduate advising services at Hunter College. And of course, I'm a business advisor to folks like you, entrepreneurs, small business owners. For the last 3 years in a row, I'm named one of the most powerful women in accounting, as well as one of the top 200 CPAs in America by Forbes. So it's a pleasure to be here with you today. So I'd like to get to know a little bit about you guys. Why we're not together in a room to do this, I would like to, if you put in the chat, tell me what city you're calling in from today, you're zooming in from, and what stage are you in your business? And then what do you hope to learn from this webinar? In no particular order, you can answer either 1, two or three, all three of the questions. I just like to get a feel for who's in the audience so I can, I'm able to tailor my presentation a little bit to you. So please feel free to put this in the chat. Okay, so what's on the agenda for today? We're going to be talking about understanding and managing cash flow. What is cash flow? We'll speak about owner's compensation. A lot of times folks want to know exactly how are they going to pay themselves. So thank you. Somebody's calling in from NYC. She just formed an LLC, so open to and signed. She's going to be in the hospitality space. That's nice. Thank you for that. We have another attendee who is not yet in business in the operational stage, but hoping to learn a lot about what to look out for. Okay, so we'll talk about ownership. So this is going to be great for you. We'll talk about ownership tax structure. What kind of business should you form if you don't have one already? Another attendee is in presenting research stage based in Brooklyn. So thank you for that. We'll explain what is the meaning between cash and accrual tax filing. What is the difference, the meaning between cash and accrual accounting? And then we'll talk about tax depreciation. And then some other tax strategies, mainly retirement tax strategy. We'll end up with retirement tax strategies. Okay, so that's my social media handles. I'm on Twitter, Instagram, and LinkedIn. But so I'll put my LinkedIn in the, it'll be on the slide so you can follow me and connect with me afterwards. I'm happy to answer any questions. So let's get started. What is cash flow? So you are in business, whatever stage that you're in your business, you need to understand cash flow because cash flow is integral to every business. What is the number one reason why businesses go out or they go bankrupt? They shut down their doors. They run out of money. They run out of cash. So cash is really important. Cash flow is the money that's coming into your business. That's the cash coming in, right? And so it's how are you getting funds? Are you getting money? Are you once you have cash flow, it gives you the ability for you to be able to pay your bills. Whether you have to understand where you're getting the cash from. Are you getting the cash from your customers or are you getting the cash from the bank? So we use this cash flow and then we'll look at cash out as well. We'll look at cash in and cash out. But really, for the cash evaluation, which every business person should do, you use the cash flow statement to evaluate the operations of your business. How many times you walk down the street in New York City and you see a business that they're there one day, in 2 weeks or the next month or in 2 months' time, you walk down that street and you see a sign on their door, shut down, out of business or going out of business. We don't want this to happen to you guys. So you need to understand the cash flow in and out. So when we talk about cash flow, cash inflow, it's your selling. Are you selling? When you're selling, you're collecting cash. That is money. That is real money that you can use to do what? Pay your employees, buy your supplies, pay your bills. Another inflow of cash is accounts receivable. What is accounts receivable? That's when you collect money from your clients that they owe you. So when you sell something to your client, whether it's a service or a goods, some goods, and they have not yet paid you, then you have accounts receivable. So when you finally collect on them, you have cash flow in it. Loan proceeds, you go to your bank or to your local credit union and you get money from them. Even though you have to pay it back, it's considered a cash inflow for now. And then equity investments, if you have some investor, you have your idea or your service, whatever it is you're doing, it's a really good idea, and you have folks who invest in you. So that is another inflow of cash. So then we look at the outflow. What are the outflows? So that's where you're paying all of your bills, your operating expenses, your accounts payable, whether it's your electric bill, everyone's electric bill is going to be crazy high this if you're in New York City because of this heat wave that we're all going through. You're paying for your rents, you're paying for supplies, all of those things, your accounts payable, all of those things. Those are all you use cash outflow to pay for those things. And then loan payments, right? You get money from the bank. Remember that money you have to repay back, and you have to pay back interest on that loan. So all of that loan payments is going to be considered a cash outflow. And then equity payments, similar to the equity investments, when your investor gives you money, what do investors want? They want a return on their investment, right? So you have to be paying them dividends or interest, something, right? So those equity payments are considered a cash outflow. So when you look at this 4 jars, right, you want your jar to be closer to jar 3 or jar 4 and not that jar number 1. That is, you've got a little, very, very little cash in there. So remember I said at the beginning of this that you need to understand cash, the way cash goes in and out of your business, because you want to be able to analyze your cash flow statements. This is a monthly cash flow statement. What you're looking at here, it shows you the cash flow statement. I'm just going to see if I can get my my pointer. We're looking at the cash flow statement for 3 months, January, February, and March, right? So you can see for this business, they opened up in the month of January, they had $18,000 in the bank. So they sold $40,000 worth of cash. They collected from clients $12,000, and they borrowed money from the bank, $10,000. So their total cash inflow for the month was $62,000. Then how much did they spend for the month? They spent $45,000 on their operating expenses, $5,000 accounts payable. They did not pay back any loans, so they paid cash outflow was a total of $50,000. So what does this mean? You say, right? These are all just numbers. It doesn't mean anything. Well, you have to continue and look down the chart. Then you want to look at your monthly balance. What is the monthly balance? Your monthly balance is 12,000. How did we get 12,000? It's your inflow, the 62,000 minus the 50,000. That's the $12,000. And then what is this cumulative balance? The cumulative balance is what you already have in the bank plus what you made in the month. So it's the beginning plus the monthly balance. So you add those two together, that's your cumulative balance. Now, what happens is that your ending balance at the end of 1 month becomes your opening balance for the next month. So this 30,000 is going to be the opening balance for February. We see now we're starting the month of February with some good cash, which is great. We have 30,000 in the bank. We sold 41,000. We collected 4,000 from our clients. So our total cash inflow for the month was 45,000. Less than January, but still, I guess you would say, hey, it's still decent. We collected some money, right? But now let's look at your outflow. How did you do in spending money in your bank? Were you conservative or frivolous? Let's take a look. We saw that our operating expenses cost us $58,000. We had bills to pay of $10,000. And then we repaid our loan because the contract for our loan said we had to start to pay back that loan. So we repaid a loan of paid $2,000. So our total cash outflow for the month was $78,000. When we look at how much we brought in versus how much we spent in the month, we see that we are in the hole. We have a deficit of $25,000. So we're like, wow, this isn't good. So then we say, well, how much did we have in the bank at the beginning of the month? We had $30,000, which is good for us. So that means that we still have a little bit of cash left in our bank account at the end of the month. We have $5,000 left. So that's unfortunately what we're going to start the next month with. So we start March with $5,000. Again, I don't know what's going on. Maybe it's relevant to the economy right now with tariffs and all of these things going on, but we did not sell as much. Our sales seems to be going down. It's going in the wrong direction. We sold 15,000 we collected cash, 15,000 in sales. We only collected 10,000 on accounts receivable. So our total cash inflow for the month of March was 35,000. We look at how much was our outflow. We spent 40,000 on operating expenses. Bills we paid for $3,000, and then we paid loan payments of $2,000. So our total outflow was 45,000. When we look at how much we spent versus how much we brought in, we see that we are at a deficit. We're in the hole, right? We are deficit $10,000. And how much did we have in the bank at the beginning of the month? Only 5,000. So that means that we are going to be in the red 5,000. So this statement is important because if you do this, this tells you that, hey, gives you the heads up. Hey, you need to go get some additional funding. You either need to go to the bank and apply for a loan or get another investor or do a friends and family round to get some money in the bank so that you can continue to operate your business. Because if you keep going down this route, and it's good to spread this out, to do this type of analysis for a full calendar year. So if you're doing a calendar year financial, you do it from January to December. So you can see which month are the slow periods in your business where sales are low and you're going to need support. You're going to need to get external cash inflow to be able to run your business. So that's why this is important. Hope that is helpful. All right. So then you see this is the, so this is actually now the analysis for the full year, right? So this is the cash flow statement for the full year. So it said that at the beginning of the year, which was in January, we started the year with $18,000 in the bank. And then at the end of the year, when we do our financial reports, you get your income statement at the end of the year. Our income statement showed that we made $25,000. And then look at this. This is really bad for a lot of businesses that carry accounts receivable. That means you're being a bank to somebody else who's running their business. When you sell something, whether it's a service or good, you want to collect your cash in real time and not be giving your clients credit, because that's detrimental to your business. So you can see here they have a heavy accounts receivable. They sold a lot during the year, but they did not collect cash, almost 91,000 in cash. And then you can see they wrote off, they have bad debts because this is not cash, bad debt of 5,400, bills, accounts payable of 32,000, accrued liabilities. What are accrued liabilities? Those are things that you owe. So let's say you owe your employees, you've not yet paid them yet. So that could be an accrued liability. And then income taxes, that they paid out income taxes. When you look at this first section of the statement is called an operating cash flow statement. When we look at the net effect of this first three section, it says that you see that you are in the red. We're in the red, 30,264. This is something that always is mind-boggling to business owners, right? They'll say, well, my business, I'm paying taxes. Why am I paying taxes? It says that I have net income of 25,000, but cash flow wise, your business is not doing good. That's why it's really important for you guys to understand that net income is not the same thing as cash, right? So here we see that for the year, we had a negative cash flow for the operations of our business. And then we look at the second section of the cash flow statement is the investing section. Here we see that we purchased equipment for our business, $16,000. So that is an outflow. Anytime you spend money, again, that is an outflow. Purchasing equipment for our business, whether you purchase a truck to deliver flowers, if you have a flower shop, or to run an Uber or something, things of that nature are called an investment. Big ticket items are called an investment. So that's why those things, they're not recorded as accounts payable, they're recorded as investing activities. So you can see that this is an outflow, $16,000. Then we get finances section. The finances section is where you're either borrowing money or you have investors. So you can see here that they paid back 20,000 of what they borrowed. And then they borrowed, they got investments coming in of $10,000. So it's a net effect of a negative 10,000. So at the end of the year, when we look at the cumulative of these three sections, there's three sections, right? The operating section, the investing section, and the finances section. When we look at all three, we see that our cash is negative $56,000. Then we go back to look at where we started from. At the beginning of the year, we started with $18,000 of cash. So what are we ending up with now? Sorry, let me erase that. Where is my eraser? I think this might be. Oh, no, that was not the eraser. Sorry, guys. I'll just do eraser. Okay. So now we see that at the end of the year, we ended with a negative cash of $38,000. So if this happens to you in year one, what do? You want to make sure you plan properly for year two. If you continue to have this type of cash flow activity, most businesses, when do they fail? They fail between the first 2 to 5 years. So this is something you take a look at it, and so that you can make that correction. Now let's get to another section. Any
Orumé?
questions on that? Go ahead.
Yeah, we do have a few questions, which is why I wanted
Okay.
to jump in. So could you go over accounts receivable one more time? Somebody needed clarification on that.
Sure. Accounts receivable. So the best type of business to go, if you go to, let me give you Starbucks as an example. You go into a Starbucks, right? You you order a coffee and a bagel and a latte and all of that good stuff. What happens before you leave the store? You have to pay your bill, right? You're not going to pay, they're not going to allow you to walk out of that Starbucks or walk out of the restaurant if you've not yet paid your bill. Those cash businesses are the best type of businesses. You provide your service to the clients and they pay you in real time. When you have accounts receivable, that means you're billing your clients. So let's say you're in construction, right? You build this house, you do some renovation, and you send your bill to the client. The client takes 30 days, 60 days, 3 months, sometimes a year to pay it. When you bill your clients, you have accounts receivable. So you are going to receive money from them in the future. Instead of you having money in the bank today, you're going to get money in the bank. So that is why this shows as a negative. For this particular year, it shows that this business, they sold $90,000 worth of business, but they haven't collected that money. Can you imagine if they collected this 90,000, they would be in the black, right? Their operating will be in the black, and their cash at the end of the year, it would all be in the black. I hope that clarifies.
Yes, thank you. And one other person was curious about the paid in, paid out section, what exactly that means.
All right, so this is for financing activity, right? So if you like I said, if you get go to a bank and get a loan, you're gonna have to pay the money that you borrowed back, right? So you borrowed money and you're paying it back. You're sending cash to your bank. So when you pay the bank the loan, your monthly payments or your annual payments, yearly pay, it is not considered part of your regular operations. It is not considered an operating activity. That is a financing activity. So that for the cash flow statement, it shows up on this particular place. Similar to if you get money from the bank, new money that comes in, that is an inflow. Okay. So you have an inflow and then you have an outflow for financing. That's what that is. So for this particular year, they paid out more than they borrowed. So let's say sometimes people, they might have borrowed money from different banks because some have better rates than the other rates. So you might pay back the bank that has a high interest rate, and you're borrowing money from the bank that has a low interest rate. So that's going to be more beneficial for you in the long run.
We
Great.
had one last question on that
Go ahead.
slide,
Okay.
if we can do that.
Sure.
So this person is curious about the depreciation bad debt.
All right.
And yeah, how that's shown in the cash flow.
All right. So depreciation bad debt. So this shows as a positive because you do not use cash. And I'll talk about depreciation. There's another slide that talks about depreciation on this presentation. Depreciation is actually not a cash expense. You do not go to anyone and say, hey, here's my depreciation expense. It is an accounting terminology. So it's not money that you're spending, but it is an expense. It's a deduction you get on your tax return. So that is why it shows as a positive. You can deduct this on your tax return. So cash flow wise, because you've reduced your tax return, you kind of put that money back into your cash flow statement because you never actually spent cash on depreciation or bad debt. And when I go into the other slide, then that will make a little bit more sense. So talking about, I think we're talking about owners' compensation. So the different ways that owners can pay themselves, you can pay yourself via salary, you can take a bonus, a commission, you can reimburse your employee expenses if you're spending money on behalf of your business. You can have fringe benefits. What are the fringe benefits? Medical costs, if they're paying for your medical insurance, if the company is paying for your medical insurance, and they're paying for, let's say, a transit card, if you have a Metro card and they're paying for that, things of that nature. You can take a dividend, an owner's draw. That's another way to pay yourself. Dividends, if it's a corporation, or stock options. And then we'll also talk about another way, retirement contribution. This is another way that an owner can pay themselves. So we'll talk about this different types of retirement contribution. An IRA or a 401k. We'll talk about this tax deferred accounts on another slide. So when you're looking at the way owners pay themselves, if you are a sole proprietor, so that means you're in business, it's just you. Anybody that starts to operate some type of business, if you open up a lemonade stand, you're a sole proprietor. If you have an extra room in your home and you are operating an Airbnb, you're a sole proprietor. If you're driving an Uber or Lyft, you're a sole proprietor. So you have an unregistered business. That's a sole proprietor. The way you pay yourself is by just taking money out of the business. It's your business. If you're the only person in the business, you just take money out of the business whenever you need it. This is you are taxed on your net profits. You pay Social Security taxes, you pay net federal taxes and state taxes. But this is the most flexible type of business, right? So it's the simplest business structure. It's easy to operate, and tomorrow you can just start operating whatever business you want to operate, and you'll be a sole proprietor. The other type of business, a partnership, this you are taxed on your percentage share that you own, right? So if you go into partnership with somebody, it could be a 50-50 partnership, it could be a 60-40. Regardless of what each partner has, it's the operating agreement that actually is more important. What you write down on that piece of paper that you agree with your partner. If there are 5 of you, if it says that, hey, you are going to all take a 20% ownership, that means you claim 20% of income. And if you guys have a loss for the year, you get 20% of that loss. So the partnership, you want to make sure, apart from having that oral agreement, you absolutely want to have a written agreement for the partnership. And when it comes down to losses, you cannot take more loss than you have invested in the business. So let's say the partnership has been having cumulative losses over the year. You invested $50,000 in the business. In the first 3 years, you cumulatively, you've taken that 50,000 that you invested in the business. Year 4, if the business has another loss, you will not be able to deduct that. So that's why we say the losses are limited. However, when you eventually sell your partnership interest, you will be able to deduct all of your losses. So your losses are not lost forever. They are just suspended if you don't have what we call basis. That's just an accounting terminology. Then we get to S corporation. An S corporation, the way owners pay themselves is what we take what we call a reasonable salary. What is a reasonable salary? What the IRS says is that if you are going to hire somebody to do the work you're doing, how much would you pay them, right? So you call yourself the CEO or the president or a director. If we're going to hire a director to come do the work you're doing, how much would you pay the director? The S corporation, a lot of times people, S corporation owners tend to want to take low salary because they don't want to pay Social Security payroll taxes. They want to save on that. But the IRS wants everybody to pay into the Social Security system. They want you to pay your payroll taxes. So they want you to take that reasonable salary, and that's that. So there are lots of different. And then once you take your reasonable salary, you can take as much distributions, what we call distribution. You can take money out of it. So there's a lot of tax savings in the S corporation structure, because on the distributions, you are only paying one type of tax. You're paying income tax. You are not paying payroll tax. On the reasonable salary, you're paying payroll tax. Okay. And then dividends, you can say you pay anything else after you've above what you've invested in the business, your profits. If you have dividends, you pay tax on that. So you can see there are some factors here that that go with the S corporation. And then for the C corporation, that's probably not going to be applicable to many of you. That's for bigger businesses. So I just went on to the next slides. My slides are going a little faster. Sorry about that. So now with the sole proprietorship, like I said, it's the tax structure. The sole proprietorship is a little bit risky. What do we mean when we say it's risky? That means you have unlimited liability. So you're riding an Uber, you're driving an Uber. I don't know what the policy of Uber is, but technically, if somebody has an accident and you are at fault and you have unlimited liability, they can come after you, your personal assets. You have an Airbnb, somebody has an accident on your property, you have unlimited liability. That means they can come after all of your personal resources, your personal wealth. So that's what we mean when we say unlimited liability. However, like I said, it's flexible and easy to form, but you are paying income and self-employment tax. You file this with your individual tax return on the Schedule C. So it's just a separate form, but it's together combined with your personal tax return. When we look at the partnership, you have limited liability. What does this mean? So if I've invested 50,000 in my partnership and somebody's trying to sue my partnership, my liability is limited up to that $50,000 that I invested in the partnership. So if they're suing the partnership for 100 million or whatever, since I have limited liability, I would only be liable up to that 50,000 that I invested, or 100 million, or whatever it is I invested. It's easy to transfer your partnership. You don't want to do that business with A, B, and C any longer. A withdraws, and D, E, and F come on the scene. So partnership is easy to transfer ownership of a partnership. You usually have somebody managing the partnership, and you pay income tax and self-employment tax. Partners are regarded as also self-employed, so you have to pay payroll taxes and income taxes. It's called a pass-through entity. They usually file a Form 1065, and the partners get a K1. A K1 is similar to the W-2 that employees get when employees get what they get at the end of the year. And then we look at the S corporation. The S corporation, like the partners, they also have limited liability. It's easy for them to transfer it. You can hire a manager to manage your S corporation, or you could manage it yourself. And the income taxes are not paid by the S corporation. It's called a pass-through entity. What do we mean when we say a pass-through entity? That means you're passing, the taxes are passing through the company. It's the owner of the company that pays the taxes. The corporation itself will file a tax return, but the corporation does not pay the taxes. It's the owner, either the S corporation shareholder or the partnership, the partner in the partnership, they're the ones that pay taxes. So the partners, the S corporation shareholders, and this should have been shareholders, would get a K1. And then we get to the last structure, the corporation. This is really when you want to, if you think that for the business, you have a startup that ultimately in 5 years or so, you're going to want to go public. It's really when you want to have a lot of investors, right? So what do C corporations have in common? Most of the time, those are the companies that are operating, that are, or you can find them on the NASDAQ or the stock market, the exchange, the New York Stock Exchange. That means you want to have a lot of investors, people buy into your company. That's when you have a C corporation. Like others, you have limited liability. You can sell your stock, your shares, your stock easily. You can manage somebody to operate the corporation. And then this corporation, this business entity is the one that pays tax. This business entity itself pays tax, whereas these two entities do not pay taxes. They file tax return, but they don't pay tax. Go ahead, Jenny.
Great, thank you. So we have a question about a partnership. Do you pay taxes on money that the business makes if you do not pay yourself out of it? Like if you just leave it in the business bank account, this person wants to invest in their business. It's a smaller revenue business. How does that affect their tax situation?
Yes, so as long as in the year, so let's say for this partnership, you had they had $100,000 in revenue, they had expenses of 60,000, and then so their net income was 40,000. And let's say they're two partners, it's a 50-50 partnership, right? So out of this 40,000 that was made, that was earned, 20,000 of income is going to go to each partner. Each partner is going to pay tax on that 20,000. So yes, at the end of each year, you will get a K1 and you have to pay tax on it, even if you reinvest that money in the business. Every year so if you have a loss or income, you have to pay tax. Once you prepare the tax return at the end of the year.
Thank you. We have
Okay.
another person who has a C Corp and
Okay.
wanted to know if they heard correctly that there is no tax on distributions. Is that correct?
Oh, C corporations actually have what we call double taxations. You can say, so with the C corporation, you're paying tax, and then I have another slide on it. You're paying tax at 21%, and then when you take money out again, when you get your dividend, you're going to pay tax on the personal level, on your personal tax return, on that on the money you took out of the C corporation. So there's actually what we call double taxation for C corporation businesses.
Okay, and
Owners.
how does somebody, I know this kind of fits in with what you just asked or what you just answered, but so somebody wants to pay themselves out of a C Corp.
Out
The
of a
best way
C
to do
corp,
that.
you should be taking a salary. So the salary that the C corporation you can be considered an employee. The salary that you pay yourself out of the C corporation is actually going to be deducted. It's going to be considered an expense for the business owner, for the business itself. So, out of this, maybe 15,000 out of this 60,000 is going to be considered salary wages. So you're paying yourself and the business gets to deduct it and you're paying taxes on the. So when you take, so for a C corporation, if there were two shareholders and they had, it was an equal shareholder. So and they wanted to take now dividends wants $20,000 because that's your share of dividends. You can take dividends out of the 20,000 dividends out of the C corporation, but you will pay a lower tax rate. You will pay capital gains tax rate, not ordinary income tax rate.
All right, last question for now, because I know we need to move on. Are you going to cover LLCs, the tax structure for an LLC?
The tax return for an LLC, that's this one.
Okay.
This is an LLC. The sole proprietor, the main sole proprietor, single member LLC, they file a Schedule C. And this is the same thing as a sole proprietor. So when you start operating, if you register, most sole proprietorships, they will register an LLC. If you don't register a LLC, you're operating under your name. So it's DBA Orumé Hayes. But once I registered my LLC, then I become Hayes CPA LLC. You have a different name. But if you are not one of these different structures, you file the taxes under a Schedule C. You're paying taxes. You're paying two types of taxes. You're paying income taxes and you're paying self-employment taxes, so payroll taxes. So that's why your tax liability is usually a little bit higher for the sole proprietorship, the LLC.
Fantastic. Thank you. Please continue on.
Okay. So we spoke about we spoke about accrual and cash. So what is the difference between accrual and cash? And this was one of a previous question. So accrual, cash, you're recording revenue when you receive it. Like I said, you go to a restaurant, you pay your restaurant bill. They're recording it as revenue when they get the cash. But accrual services, you determine and recognize revenue when the services, when you perform services. So if I am using accrual to do tax returns in my business, once I prepare the tax return and I give you your tax return, it's complete, but you don't pay me, and I prepared the tax return in the month of February, I'm going to recognize the fact that I have income in February, even though I might not collect that income until April or May or something. So that is what accrual is. Similar to revenue, it's the same thing for expenses. When you use up your expenses, so right now when you talking about utility and the heat wave, your heating bill or your electric bill, if you've used up your electricity last month for the month of May, you're going to accrue the bill that you the expenses that you spent in May, even though you might not pay them until 2 months down the road. So that is accrual. But cash, you go to a shop, you go to Staples to buy some office supplies, you pay for that supplies immediately, whether you're paying with cash or credit card, that is cash. Accounts receivable is similar to, again, you're going to collect money in the future. If you're using cash, you don't have any accounts receivable because you're getting your cash in real time. The reason we have bad debt under accounts receivable is because at one point in time, you recognize revenue when you perform services, right? So the IRS recognizes the fact that not everybody pays their bills, right? So if you recognize that you sold something to your customer in January and February, but now it's the end of the year, December, they haven't paid you, it's year one went by, they didn't pay you, year two went by, they didn't pay you, you're going to have to write that income off. So that is why you have bad debt. It shows that you never got paid for the revenue that you recognized previously. But if you're using cash, there is no such thing as you don't have cash, you don't have bad debt because you're doing everything with cash. So accrual is a little bit complicated. Cash is simple, and the method that is used by a majority of businesses, especially small businesses. There's some other things. If you need to switch methods, you have to file a form with the IRS. But most businesses use the cash method. So getting to our tax rate. So this tells us, gives us our tax rates for this year. So we have 2, 4, 6, 7 tax rates. Our lowest income tax bracket is 10%. It goes up to 37%. So this tells you for single filers, anytime if you make under basically $12,000, you're going to be paying tax at the 10% rates if you're a single person. For married folks, if they make under 23 or 24,000, I'm rounding up, you're going to be paying tax at the 10% tax rate. And if you have a head of household so you're the person, you have a child or two, or you have somebody else living with you that is under your watch, you're considered head of household. So if you make up to $17,000, you'll be in the 10% bracket. The more money you make, the higher your tax bracket. So you can see this just tells us. So obviously, if you're making a whole lot of money, if you make just over 600,000 as a single person, you'll be in the highest tax bracket in the US, which is $37,000. And then now I remember I spoke about the corporation. So the only corporation that pays taxes, like I said, is the C corporation. C corporations are taxed at 21%. So this is where I said the double taxation comes in. If you have a C corporation, first, if your business is profitable, you're going to pay tax at this 21%. And then if you take out dividends, you could be taxed at dividends. The dividend rate is from 0 to 15%. So it's a little bit lower than the income tax rate. And like I said, the partnership and the S corporation and the LLC, these are all passed through. That means you're paying taxes at the individual rate. So you're going to be paying taxes at this rate because it flows through to your personal income tax return. All right, so I said previously that we'll touch on depreciation. So depreciation, the concept of depreciation, it is an allocation concept. It's not a valuation concept. However, the easiest way to explain it that most people grasp, you always hear this story, the say that if you walk into a auto dealership and you buy a car, immediately you drive that vehicle out of the parking lot, the value of that vehicle goes down. So it's kind of similar, but it's just that when we talk about accounting-wise, when we talk about depreciation, it's an allocation concept. It's not a valuation concept. So the way this is like you buy an equipment. So if you think of a big ticket item, so let's say a Boeing airplane, it probably costs $100 million or something. You are not going to write off $100 million in 1 year because you can use that airplane for 20 years, 30 years or so. The same thing with a building. So for things that you can use for a long lifetime, we want to do what we call allocate them over the period of time that you're going to use them. So for this example here, you can see the purchase and equipment, right? So in this case, we're writing off $480,000 in the year, and we're allocating it's 480 divided by 12. Every month we get to depreciate $40. So it's how much you are allocating. The same thing if you buy a vehicle that you're using, you buy a truck that you're using for your delivery. You're not going to write off the 20,000 or the 30,000 that you purchased that truck in 1 year. You're going to depreciate it, allocate it over the 5 years that you're going to use that truck, so to say. Most people use this, most businesses use the straight line depreciation because that's the easiest type of depreciation. So some other things that this might not be relevant to you guys. If you are for expenses, if you buy expensive items that are under $2,500. So for example, you buy a computer, a laptop to use for your business, usually you would have to depreciate it, but now you can expense it. That means you can deduct it all at once. That $2,500, you can deduct it on your tax return in year 1. You don't have to say that, hey, because I'm gonna use this computer or this laptop for the next 3 or 4 or 5 years, I need to allocate that $2,500 for 5 years. You can take it all in 1 year. And there's some other things called bonus depreciation. Right now, the bonus depreciation is at 40%. That means you can take 40% of an expense of a big ticket item that you buy. Only if you're buying, this is only applicable if you're purchasing big ticket items for your business, right? You have to buy a tractor, a new building or things of that nature. All right. There's also some other deduction. You can deduct up to $1.2 million. I don't think that's going to be relevant to anyone here. Although I do want you all to sell up to want your businesses to be profitable and get to where you're making $1 million and buying $1 million of assets. But if you get to that stage, you'll be able to deduct a lot. Now, there's another deduction type of savings that businesses qualify for, which is called the QBI. You might have heard about it. The businesses get to take 20% additional deduction before they pay taxes. So this deduction affects individuals and all the different types of businesses. You have to be operating locally in the US, if you are what we call a specialized trade or business, that means you're using a skill that is particular to you, the owner of the business. So like doctors, lawyers, accountants, we are limited in how much we can deduct on those QBI. But so let's say, if you made 100,000 net income, you'll be able to take 20% of this. Right, so that means you get to pay tax only on 80,000 instead of the 100,000 because you get that 20% deduction. So now that is a tax law that is set to expire at the end of this year if the Congress does not renew the 2017 tax bill, or if they don't change it. They're still going through negotiations currently. Go ahead, Jenny.
Quick question. What about C Corps with this QBI deduction?
C corps are not eligible because remember when you look at the tax rates that I showed you, C corps are taxed at 21%. What do you see out there? This 21% is much lower than all of these other percentages. At least it's lower than most of them. The only tax rate that's lower is the 10 and 12% tax rate. So that's why they do not give C corps an additional 20% deduction. You get that?
Yes, thank you. And we have another question that I'm going to hold until the end. It's about a specific type of accounting. So go
Okay,
ahead for now.
sounds good.
Thank you.
All right. Then we have, so once you're operating your business and you start to hire people, you want to decide that you're hiring an independent contractor or an employee, or what we call a statutory employee. The IRS has a 20 factor test that they used to hire, that they used to determine the kind of individual you've hired, right? So what's the behavioral control, what's the financial control, and what is your the view of it? Basically, what it is that you're looking at is, are you telling the individual what to do? Are you give them the schedule when to show up to work? Are you having them, are you supervising all of their work? You know, so the things, the big ticket things that can differentiate between an employee and a contractor. If you are telling your worker what to do, when to show up for work, when to end for the day, and all of that stuff, you have an employee. If you hire somebody and you give them a contract, hey, you're an independent contractor, this is what I need you to do, go do it on your dime, on your time. I don't care how you do it, just come back to me with the results. Then you have an independent contractor. But it's very important that you know what type of individual that you are hiring, because sometimes what by some business owners is that they think they're hiring an independent contractor. They pay their workers an independent contractor. When that work finishes, that independent contractor goes and files for unemployment. And then what happens? They're denied because, hey, you never paid into the system. You never paid any payroll taxes for them. So they're denied. Then the states, they're going to come after you because the individual is going to go complain to the state that, hey, well, I was really an employee. I wasn't an independent contractor. I was told what to do, when to show up to work, and blah, blah, blah. So they'll go through the test. So you really need to know when you start to hire people, if you have employees or independent contractors. And then I know we're running out of time, so let's talk about your retirement, your future. This is very important. Retirement, you want to boost your bottom line. You want to boost your, you know, use your business to boost your future retirement. So you can do that by contributing into a bunch of different plans in IRA, Roth IRA, or 401k. There are lots, a traditional IRA. Your business has to be profitable for you to be able to contribute money. So if your business made, if the net income for your business was, let's say, $6,000, you'll be able to contribute $6,000 into your traditional IRA. You can contribute up to $7,000. If your business made $36,000, the maximum you can contribute for your individual IRA plan is $7,000. And then if you're over 50 years old, you can contribute another $1,000. So what this means is that you are, this is going to reduce your taxable income. So it's tax deductible, right? So, but when you withdraw that money, that your retirement, when you retire, when you withdraw that IRA, you're going to pay tax on it. You're going to pay tax on the original money because you never paid tax on it, and the interest, the money that you made on top of your original investment, you're going to pay tax on it. You can also roll this over from when you move from employer to employer. Once you get to age 59, you can begin to withdraw money out of your IRA account without paying a penalty. And then once you are age 73, you will have to start taking money out of your IRA account because the government wants everybody to pay taxes. Remember, any money you put into the IRA, when you put that money into the IRA, it's not taxed. eventually the government wants you to take that money out so that you can pay your taxes. So that's why this is mandatory for you to take money out at age 73. And then when we look at the Roth IRA is different from a traditional IRA. This Roth IRA, it doesn't give you any deduction. What does this mean? That means you actually pay tax when you make that contribution into your retirement account. However, when you withdraw your money, guess what? It's going to be tax-free. Both your original investment and then the money that you make on top of your investment, it's all going to be tax-free. Okay. And then if you wait until after age 59 and a half, everything, both is all tax-free, including the interest money that you make. And sometimes you can convert your individual IRA to a Roth IRA. Another type of withdrawal retirement account is what we call a defined contribution plan, or is a elective salary deferral. So you heard of a 401k, that this is for private employers like myself, a 403b, or if you are working for a not-for-profit, or a 457. If you're working for any of this type of company, and you as a business owner, your business, you can operate, you can open up any type of this plans. If you open a 401k, instead of contributing only $7,000 for the year, guess what? You can contribute up to $23,000, $23,500. So that's if you are saying, hey, retirement is coming, I really need to start to plan towards my retirement and contribute money towards my retirement. As long as if your business is profitable, hey, instead of you paying that money to the government, go ahead and invest into your future and contribute this money, 20,000, 15,000, 10,000, whatever, you can contribute that money. And then if you're over 50 years old, you can actually contribute a little bit higher. So a total of 30,000 and change. Another one, if you don't want that plan, another plan is called a simple plan. This is savings investments incentive match for employees. For this particular plan, you can contribute up to 16,500. So like I said, there are different plans that you can contribute different types of amounts. Solo 401k plan, you can contribute to different type of accounts. And then if you open a new retirement account for your business, guess what? The government, because the government wants people to plan towards their retirement, they will give you a $500 credit that is taken on your tax return for opening up a retirement account. And there's some other credits, incentives that you get as well. This is just a grid that shows the different type of retirement plan. You can take a look at it and see which one you want to open. Some of them are easy to maintain. Some of them come with fees, but you can open up any of these retirement accounts at your bank. You just tell your banker you want to open a retirement account, and they will walk you through any one of these accounts. All right, so I will take any other questions that you have. I know we have only a few minutes left, but I will take any questions that you have.
All right, we'll do speed round questions, Orumé.
Sure.
So we have a person who has recently moved to New York and wants to find out how to get in touch with defense contractor accounting audit specialists. Do you have recommendations on that?
Defense contractor. So this is something where you will have to just do a search. If you want to reach out to me afterwards, I'll share my slides, and my slides has my contact information. It's actually on the screen now. You can also grab it from the screen. It's service@oha.com. If you want to send that to me, I'm happy to share that request within my network, within the New York State Society of CPAs. But that is not, I don't know anyone in that area. So it's something that you would have to do research on.
Fantastic. We've had a few questions about the recording and the slide deck. Yes, we will get those to you in a follow-up email, because I know this was jam-packed with so much fantastic information. So we will get those to you for your reference. All right. Can you go into a little bit more detail on businesses that qualify for that QBI 20% deduction? Are there specific kinds of businesses?
Most businesses qualify for it, and you can take the you can take the deduction up to, it's unlimited for most businesses. However, what we call an SSTB, which is a specialized services trade or business. An SSTB is when you're in a business that uses a particular talent. So like a doctor, a lawyer, a chef, a CPA. Folks, when we have those specialized services, we do not have unlimited 20% deduction. Our deductions are capped. But other businesses, you open a retail shop, you can have an unlimited 20% deduction on your profit.
All right, and here is our last question for the day. This person wants to know if this statement is correct. So you pay taxes on interest earned on an IRA withdrawals upon the withdrawal. So sorry, you pay taxes on interest earned on IRA withdrawals when you withdraw. Let's put it that way.
So that would only be applicable to Roth.
Okay.
On a traditional IRA, you're paying taxes both on your original contribution and on the money earned. On a Roth IRA, you are because you've never paid tax on it. On a Roth IRA, because you pay taxes on the when you made the contribution, it's growing tax-free. That's going to be tax-free for the Roth.
Fantastic. I think we have gotten everyone's questions miraculously. So I want to say thank you so much to Orumé and Greg and to all of our attendees today. You will, remember, get a follow-up email that will have resources for you. And also, when we shut down the webinar here, you will see a survey. We'd love to get your feedback. So if you have a couple of minutes to fill that out, please do. And Orumé and Greg, any last comments as we finish up today?
Good luck, everyone. Good luck with your businesses. Reach out if you need to, and stay cool if you are in New York City.
Orumé, thank you so much. That was an incredible amount of information, and you got it all in an hour, and you handled the question. So thank you for sharing your expertise and your time with the attendees today. Jenny, thank you as always for making sure that everything runs smoothly. And to all the attendees, thank you very much for tuning in. We really, really appreciate it. Again, I put in the contact information for the PACE SBDC at the top. It's pacesbdc.org. We'd love to try and help as many of you as we can. Again, all of our services are totally free of charge, so I would encourage you to visit the website, pacesbdc.org, and register to become a client. And thank you very much, everyone.
Thank you.
All right. And there are lots of thanks in the chat and awesome job. And so just wanted to pass those along, Orumé. Have a lovely rest of your day, everyone. And indeed, stay cool. Bye-bye, y'all.
Cheers.